So, hi everyone, welcome to Outgrow's Marketer of the Month. I'm your host Saksham Sharda. I'm the creative director at Outgrow, and I have with me here my co-host Anushka Chopra, who's the social media and outreach analyst at Outgrow. And for this month, we are going to interview Jeppe Kirk Bonde, who is the most followed investor on Etoro. So, Jeppe, we're going to start with a rapid fire round just to break the ice. Try to keep your answers to one word or one sentence only. And Anushka is going to start with the first question.
All right.
All right. So the first question is texting or talking?
Talking.
How long does it take you to get ready in the morning?
0 minutes.
You just get up and you open your laptop.
Exactly.
That's
All right.
awesome. Yeah, all right. So Instagram or Facebook?
Say that again.
Do you prefer Instagram or Facebook?
Instagram.
Okay. Nickname your parents used to call you.
Jeppe.
Okay.
All right. Books or movies?
Books.
Last song you downloaded.
The Strokes. Electricityscape.
Huh.
All right. A digital watch or an analog watch? Which one do you prefer?
Analog.
Okay. I prefer digital, but okay. How many tabs do you have open on your browser on an average?
So right now I have open about 22, and that looks low. So, but not much more. I think when I reach 30, I always sort of evaluate.
Your life decisions. You start evaluating
Yeah.
your life decisions. All right.
Okay. At what age do you want to retire?
50.
Hmm.
Okay.
How many cups of coffee do you drink per day?
2 caffeinated and 2 decaffeinated.
Okay.
Okay. What's something you could eat for a week straight?
Sushi.
Me
Have done
too.
that many times.
All right. Fill in the blank. I can survive on dash hours of sleep.
3.
Yeah, from what I know in
Right.
Amsterdam, yeah. For sure. Okay, so that's the end of the rapid fire round.
Yeah.
Let's move on to the bigger questions. Anushka, you want to ask the first one?
Yep, sure. I'd be happy to do that. Okay, so Yepe, from a consulting manager to an investor, how has the ride been so far? And I'd also love to know why you started investing in the first place.
Yes, so I think it's been very smooth transition, and there's been an extremely good overlap between the skill sets needed to invest well and also to advise management on how to run their companies. Essentially, when companies get big enough, everything is about strategy and investments at that level, because you need to choose how much you're going to pour into something or something else, and how to sort of so there's a lot of overlap between what you need as a strategy consultant and what you need as an investor. I originally started because I started making money, and I had excess capital every month, and I wanted to invest it. Then of course I had the option to use my normal pension fund, but then I learned that my options for our company program was they would put 75% maximum in stocks, and it would only be in big Danish stocks. So like I could definitely do better than that. Then I just went for it on my own, and then I started doing quite well, and then it went better and better and better, and then I just never stopped with that. And then eventually, of course, as I was doing so well, more people on eToro started to copy me, and then in the beginning I just thought, it's funny, now I just made $300 from people copying me, and I made $500 from my investments and whatnot. And then it just kept growing until eventually I was making a lot more money from this than from my actual advisory role as a consultant. And then I decided to focus only on the investment side of it.
Hmm.
Right.
And do you think a lot of consulting managers are in the investing business now? On eToro, for instance?
I know that there was at one time another management consultant as well who was one of the top investors. So there's at least been two of us on Etoro like that. But otherwise, I see people coming from many different places. But it's one good avenue. But also management consulting is a very big field. So I think in particular, if you come from strategy consulting or something where you've worked a lot with valuation, it's a very big plus, because I see a lot of, for instance, consultants that know a lot about IT, and they understand that a certain new piece of software or a new sort of trend is going to change some things, but they are just not really capable of telling whether that business is also fairly valued. So is this great future already priced in? And without sort of that ability to just analyze the financial statements and understand what's really being said between the lines of the the management and so forth, without that you can't probably assess if it's also a good investment, even if you have the skills to understand that this is a great company.
Mm-hmm. So what do you think like is the overlap between what you do and what venture capitalists do? Like, and what is the difference?
So I think there is it's sort of there is a at the very lowest level, from like you know at seed capital level and before, it's there's much less data to go on. There's a lot more sort of, I would expect at that level you have to analyze 100 companies to find one good one. As you get a
Mm-hmm.
little bit further down the line, there's more information available. There's has been more selection process, but of course then if you do pick up a company at the very early stage, you have a much longer runway to really make a great amount of profits. So I think there's some there is some similarities, especially if you're looking at growth companies. Then it'll be more similar. And I think also we are seeing many companies now IPO earlier, which means they have more in common with private equity and with venture capital than they actually do with large established stock companies, because they're really still at the stage where the focus is entirely on growing revenue. You have companies that are being IPO'd that have in the past year increased their revenue by 100%. So that's numbers, and without being anywhere close to profitability, they might be having a 50% loss in the past year. So that is much more similar to a startup than it is to a mature century-old high profit business.
Mm-hmm. I completely understand, because you were talking about.
Yeah.
Oh yeah, I don't know how much I'm like. Okay, let's go. Anushka, you were saying something.
No, that's all right. Please continue.
I was gonna say, what do you think about Uber?
I
For
think I
instance?
use Uber a lot. I've just been in Russia and used Yandex as well. And I think here in London we have something called Via Van. So everywhere there are some small competitors now. Uber is working with Yandex.
No, I mean,
And
like, for instance, about the Uber's IPO, because like I'm building it from there. So.
yeah, so I'm just saying in general, I really think it's nice that you're able to get movement around like this. But I think besides the person transport, there's a really great opportunity for goods transportation. So we're starting here with the Uber Eats, getting a pizza delivery
Mm,
and whatnot. But there is this whole sort of um, delivery to your home business that's being built. It's currently being competed by between post offices and Amazon going into it on their own, and
mm,
Uber and other delivery companies. But essentially we're fighting the big war now for how to get everything in your home delivered really easily, and having maybe only one or a few really well organized companies that will come to your home anyway multiple times per day. So when they're already coming to deliver a pizza, that's a time they might as well also be bringing that thing that you bought and so forth. And I think Uber actually has a shot at that, which makes them more valuable. However, in the person transportation side, in general, when you're building a business that has where you have to build both sides of the market, it's very difficult. So in this case, you're trying to make drivers meet riders. That's difficult because you need to build both sides of the business. It's easier if you just have to sell a product and find buyers than to have to find sellers and buyers. But once you get to the stage of the self-driving car, could be in 25 years or 40 years, then at that stage you eliminate one side of the market. You no longer need to find the drivers. So then all the hard work to build both sides of the market won't be worth as much. And then it's a question of whether the things that are considered very difficult now, like building a good app like Uber has, if that's really difficult enough that others won't be able to steal a large share and drive down the profitability. That's what I'm afraid of, and that's why I'm not invested in Uber at the moment.
Okay. All right. I'm going to ask the next question now. So you have a background in strategic planning. How important do you think it is for a company to make data-driven decisions?
I think it's very important to look at data and make data-driven decisions, but I think there is you have to also apply common sense to the data. There's a lot of people who do simple regressions on past data, but then they miss sort of like the big point. Having 20 points of data and increasing the complexity of your model and trying to use all the data in the organization, it can sound better, but in practice it will give you worse decisions. If you can sort of on anything, it's even if you're valuing a company or valuing whether product will be successful or so forth, if you just get like the 4 or 5 most important things right, then that's more than enough. So you don't have to sort of like get every single little piece of data. And in a world where you have a very very high availability of data, you can sort of succumb to that mistake of then spending not even just time, but actually spending part of your model on certain small pieces of data that should just be ignored. So it's more a key of finding out like which 5 or 6 things are actually really important and will drive my decision on this, and then being able to deselect what you can choose to ignore.
Okay, yeah, okay, that completely makes sense. Anushka, do you want to ask the next question?
Yep, sure.
Number 3.
Yep. So, say someone has to invest in a small business. What are your thoughts about that particular market?
For investing in small businesses,
Yep.
I think it's if you can find the right ones, it's great. I mean, the only issue there is of course that you just whenever you attend these events to meet many different startups and so forth, they are the best ones also now an idea that they are worth a lot. So they are they've come up with a very very high valuation, which makes you not want to invest. And so that's been my experience, unfortunately. But yeah, of course, if you can, you always need sort of like in order to, that's the same for stocks. In order to find great companies, there's no sort of like easy way to do it. If you take a big data set of all the companies and then you try to sort for them, for sure the ones that you will find based on whatever model you use, there will be something else wrong with them, which is the reason they show up whether well in the model. So you need always to have some, if you have the right person that gives you the right tip at the right time, or you have the right sort of like a hub of people meeting in a certain place, and that can, you need something like that that can give you the way into a company and an idea that for some reason has escaped larger investors.
Okay, so what are some things that you look out for before actually investing in a company or in bonds, for example?
So I analyze them very carefully. So I look at all the financial statements. I listen to all the conference calls and hear what various interviews I can get with the CEOs. I like to talk to people who work in the business. I can view people's LinkedIn profiles, what they say about working in the business. There's a lot of stuff available online just from reading the product reviews, seeing what do I think about the latest products. Oftentimes I buy various products, and like right now I have my Google Home and my Alexa in the house, so I sort of compete them against each other to see which one I like more. And with all of those things, you sort of if you start out with a blank sheet, you know nothing about a company, then in the beginning you're just learning new and learning new and learning new, and then after a while you start to be like, right, yeah, I know that, yeah, right, I know that, and at that point like, okay, fine, I'm not getting a lot of new stuff now. I can feel confident that if there was some other big thing out there, then that I wouldn't be discovering, then more research now won't make me discover it. So I can be clear on my assessment here. Then I have my financial models, and then I based on what I have then found, I give what I think is the fair price, and then if that fair price is significantly higher than what the market is actually trading at, then I'll make an investment.
All right. Okay. Yeah.
Okay, I'm going to go for
So,
the next question. So
yeah,
tell me
please.
something most investors think is true, that you think is bullshit, or something that you think that is true and most investors think is bullshit?
Well, I think one thing that everybody's getting wrong, including top economists and central banks, is that they are looking at inflation instead of seigniorage when calculating your real return on capital. It's sort of like um, it's a little bit complex, but essentially, if you have an economy that's growing at 2%, 2% more people, 2% more goods, 2% more transactions, 2% more of everything, and there's also 2% more money, then you will see inflation at 0%. But your real return is actually you've lost the 2% of the extra money that was created, unless that went proportionally directly to you, which it probably didn't. So when you see an inflation rate of like 2%, but it's in a growing economy, your actual net loss on having just kept currency is even higher than that. And so I think that leads more people to keep more money in currencies than is actually than you would really want to do. And that's a common mistake. I mean, obviously there's lots of other people who this is at a second level. There's a lot of people who just get inflation wrong basically. So when they're talking about how much something has grown, they are forgetting about inflation, or if they're talking about how much they're calculated they're gaining per year, they're forgetting the inflation bit. So it just distorts the whole sort of like view of how things are actually growing.
Mm-hmm. And what is something that you think is true that most people think is bullshit? The other way around. So if you flip the coin.
I think blockchain is a very bad technology. I think it's for any given project, it's extremely unlikely blockchain is the best technology you would use for that. I'm very happy to see Libra coin is basically not using blockchain. They're using it in sort of name only. And I think that you can maybe get around it by calling it crypto, or sort of changing the definition a bit. But blockchain has become this big brand where people think, oh, it's great because of decentralization. But if you really think about it, when you have a lot of buyers and a lot of sellers, for instance, it could be for goods. So then you have all the buyers and sellers meeting on Amazon, or it could be for like a terminal port. So you have all the ships that need to meet the different cranes in the terminal and so forth. Then you do not want decentralization. You want a nice central entity where all the buyers and the sellers meet, and you do not necessarily want everybody to have a vote on how to change that central system. It's quite fine. So this whole thing with like cutting out the middleman, that you're not really cutting out the middleman, you're often creating a central middleman. And if you want decentralized control over that central middleman, you can just have that. You know, if 8 shipping companies wanna decentrally control their own like portal for managing how cranes meet ships, then they can just have that as a joint venture where they each own 1/8 of the joint venture and then vote like that. So you don't even need blockchain in that case. So so you don't usually need the decentral model, and even when you do, then you don't need blockchain for it. So I think Bitcoin is incredibly successful despite being on blockchain. It would be better if it was not on blockchain. Unfortunately, it is on blockchain, but because it's the first big private currency and private currencies are awesome, then it's really good. Now, if someone can go out and make an asset-backed private currency that's not based on blockchain, then I think it has even greater hopes.
And so you think Libra will do pretty well?
I don't know. I think they can. They can. I think they are getting a tougher eye from regulators because it does seem more serious, and because so with any of these projects here, it's more likely it will not succeed than that it will succeed. But that's still fine. You can manage those probabilities. It's being good at investing is not about being right more than like 50% of the time. It's as Jeff Bezos says, we take a lot of bets where we are, 9 out of 10 will fail, but the one that succeeds gives you back at times 100. So you have to be, willing to take those as well. And of course, it can from a marketing perspective, that's always tough because you do a project and it has a high likelihood of failing, and then it fails, and then everybody comes like, look, you failed, you invested in this thing, or you worked on this project and it failed. But that's just the nature. That's the nature of consulting projects, of startups, of businesses undertaking new initiatives. Anything that does something new like that has a quite high likelihood of failure. But if the potential return from it succeeding are high enough, then you just have to do those things over and over and over again, and then in the end you'll have a quite good return as a company and as an investor.
So how many because you've spread your eToro portfolio amongst like many companies, right? So how many of them, like, because a lot of companies are getting into blockchain. What do you have to think about that? Because they started using it for random stuff. So what do you have to think about that?
Well, so I think that many of the consulting firms know that blockchain is useless, and they are still sort of like, some have now taken it off their website, so they're trying to sort of like backtrack a little and be not a. But there are others that are still saying no, it could potentially have some uses. We're just not there yet. And then there are many of the largest companies. They have made blockchain projects, and then they realize that it is not the best technology for the specific thing they're doing, and then it's just sort of quietly being phased out, or they're still touting it as this will be something big. I mean, you have other companies that are just, they just put down $10 million to do a blockchain project to be able to do a big press story, and that press story has already generated more sort of like branding awareness to pay for that project. So the project doesn't have to do anything. um, it's just sort of like, because there's this big attention to blockchain, then it can be used as a way. And also, if you're doing a project and you add the word blockchain, it might get more like attention. And so until sort of people come to terms with the fact that it's not um the technology of choice for most projects, for like 99.999% of projects, then it can continue to have a strong brand, and people will think that it's interesting and new. But sometimes it's yeah, I don't think that's the case, and so I'm not investing in tons of small blockchain based startups. And if there was a big company that I had that was actually doing something more than just in name, then maybe I would look to get out of those and be like, right, they are betting on the wrong horse here.
Okay,
Yeah.
right.
Yeah. So I'll ask the next question. Yape, can you walk us through your investing process? Because I mean, you're clearly very good at it, and I'm sure our listeners would love to know what are the steps that you follow.
Yeah, so first I need to get ideas for stocks to consider, and I myself start from the very top. So I analyze, how do I think the world economy is going, the different regions and industries, what is their growth expected to be. Then I look down, saying, okay, within specific industries in specific countries, um, which ones do I believe more in? Which mega trends do I think are more interesting? Then I compare different companies that are riding those mega trends or in those industries, and I compare them. How are their products in comparison to each other? How is their profitability? What are their growth prospects? Do I like the management? What are people saying? What are people who work in the company saying, and so forth? And then based on that, I find maybe one company or two companies in that industry that I want to pick. And but then sort of that's the sort of big top down approach. But I also get a lot of tips, both because I have so many I have 80,000 followers and 6,000 copiers in Etoro, so they write me lots of ideas. And whenever I'm out talking to people and just living my life, buying new things and checking new things out, then there's companies come to mind, and then I research them as a potential investment. And then quite often what happens is, I don't invest in that particular company or that idea someone told me, but maybe they have a supplier, maybe they have a competitor, maybe from that springs another idea. I tried also the other methods. I used the stock screener to look at every single stock in the world. Let's look at all of the financial metrics for them and rank them in a weighted manner to get which ones should be most interesting. But doing it in that sort of like a big scaled way, in my experience, doesn't work. All the ones that come up on top, they look good then based on that particular model you used, but then when you analyze them in detail, you find there's something else wrong. Like, yeah, this company has their stock cost nothing and they are massively profitable, but then you find out actually there's a lawsuit and this is gonna ruin them or something like that. So it's so as you sort of, I think again, you have to find these sort of little sneaky ways in where an idea or hypothesis somehow gives you something that's not properly seen in the market.
I was gonna say, you're saying something?
Yeah, I mean, I was just really curious to know what, according to Yape, was his best and worst investment. I mean, or maybe a missed potential opportunity that you just thought of in hindsight, and you were like, "Oh, I wish I'd invested in that."
Yes, so the best ones have been some of the big tech companies like Amazon and Facebook and Apple and these companies. The worst ones have been in general my investments in Chinese companies. Some of them have done relatively well compared to Chinese companies, but overall, I've lost money on my investments in Chinese companies. And the ones that are sort of like that I regret are the ones that I came very close. So I valued them to be very good investments, but not good enough that they were better than my other investments. So I have all my investments ranked, and the ones at the bottom are always, of course, at risk of being replaced by something that's almost good enough to invest in. And so some of the ones that, like Beyond Meat, came very close there, and so that was sad that didn't just make it in. But that's it's not that big a deal. There's thousands of companies that will do well, and it's as Warren Buffett says, you don't need to, he's done it very extremely. So you don't need to make a thousand good investments. You just need to do you just pick up like 10 great companies over your investing career. That can be more than enough.
Mm.
Yeah,
I was
makes
gonna
sense.
say, because what you had mentioned to me that when you invest, on eToro, when people invest in general, they have like a range of companies they're investing in. So one shouldn't be looking at short-term returns, but there can actually be a stable long-term return. So you were talking about something. You want to elaborate on that?
Yeah, so I mean, I always say that you should have at least a 5-year horizon for your investments.
Mm.
It's like time in the market beats timing the market, and I I ideally think people should think in decades, not in years. But of course, there are others that think just in month. What will be my return in 1 month? It's like that should not really come into your mind. You should be thinking much more long term. And there, in general, I mean, stocks have been on average going up by 7% per year for whichever long period you want to think about it, whether you think for 100 years or maybe 800 years. So in any given year, it can double or halve. It might in any given month go up or down by 10%. But sort of the long steady trend is that averages out over a long period of time. So you can be unlucky, you start investing and then it goes down just as you had started, and then you might be discouraged for life. And others, they get started and then they have a good experience in the beginning, and then they are luckily then in it for life. But it shouldn't be sort of like that determines it. You should really just look at history and be like, right, setting aside capital to invest in markets is in the long term a really good idea in general. And then how you want to do it specifically, if you don't know anything about investments, then you probably want to have just get the market average. So that just use ETFs or whatever to just say, I just want to have the average, I cannot do any better. And of course, if you think you can do better than the market, or you have time and can do it, then you can start to say, actually, I'm not just going to have every single telecom. I'm gonna pick the one that I really like. I'm not gonna have everything. I'm gonna pick the ones that I really think will beat the average, and then
Mm.
then you can do better. But even still with that, you can still you can reduce your risk a lot using diversification. So that means you have stocks from different regions, from different industries, of different sizes, that are different maturity stages, that are different stages of the value chain. So if you diversify all those things, you do not need to have 10,000 companies to be well diversified. Mathematically, when you go from one investment to 10, you'll say, if you only have one investment, that's probably the company that you think is the most undervalued, the really good one, but then you have no diversification whatsoever. When you go down to 10 companies from different regions and industries, now you actually have a lot of diversification, and you haven't put in too much trash in the portfolio. But when you go down to have 10,000 different stocks, you're not actually getting that much more diversification. It's sort of like it tapers off. So if you have probably something like 20 to 40 stocks that are correctly picked, that'll give you sufficient diversification. But of course, it depends that if you have only 20 stocks and they're all American tech stocks, then they're likely to give you more wild swings together.
So one could technically arrive at a particular average number per year for an increase for a diversified stock, right? There must be a particular number, because you're saying yearly it tends to like do better, or like you're saying per decade, you should be looking at it in a decade, right? That's what you're saying.
So it averages out over a long time. It'll definitely not average
Mm.
out in any one year. The stock
Mm.
markets overall have historically been able to double or halve. So that so if you're unlucky, you come. But even then, if you had invested right before the last financial crisis of 2008, like you just came in right then, and then immediately you lost 60%, you would be like, or immediately lost 50%. But then if you had just you'd done that at the start of this year, you would have still have been up by 60% in total. So that's sort of that's sort of like, yeah, you might and technically over a decade, if your stocks double then half then double then half, and then plus minus then, and then at the end you can see, right, I made on average 7% per year. That's then the total thing that matters. It's not necessarily that. And also sometimes the short movements are really sort of, if the stocks, if they raise the interest rate and that causes stocks to be valued lower, I'm like, yeah, but that's because they're now measured in higher value currency, and we also have a more safe sort of financial system as a result. So you're sort of, okay, fine, I'm losing some here, but I'm gaining something here. So if you're just only looking at oh, it fell by 10%, it went up by 10% as a lot of a short term thing, then you won't be able to find the best investment opportunities. Yeah, you have to sort of, a movement on its own doesn't tell you anything. Essentially, it's how does that move compare with how the world looks now?
Because I was just wondering, because here at Outgrow we tend to make return of investment calculators. So I'm just thinking, does Etoro have those? Like, does Etoro show you your return of investment over a year or over 10 years?
Yeah, it has all the data. So you can export every single little piece of data, but it also shows some nice dashboards, so you can go in and see, like, what has your return been each month, what has your return been each year, what has been the return on the different investments, and so forth. You can also
So
see
I think
like
if it
how.
was presented infographically, it would like have a deeper impression on people. Because I think if you just see it in like short bits or like short term, then you're less convinced than if you could actually see it in a long term graphic way, as to like the way you just explained to me. If I'd gotten in just before the recession and stayed until today, I would still be 60% up, right?
Exactly, that's one good thing. Another one thing to have in mind is stocks. Now, I personally, since I started investing, I've made 33% per year on average. So that means doubling the value quicker than every 3 years. If you look at the market average growing at 7% per year in real return, that means doubling the value of your portfolio every decade. But if you double every decade, that means that after 2 decades, 20 years, you have 4 times. But after 3 decades, you have 8 times. After 4 decades, you have 16 times. So it sort of means actually from a few years of good investment, you can, and that you can at the without removing inflation from it, you can after 4 decades have 16 times that. So you can really sort of like, in that sense, build a fortune in the long run through investing.
Okay. All right, Anushka, you want to ask the next question?
Yeah, sure. Yepe, like, I mean, you're the most popular investor on eToro, right? So does having a large group of people following your investments change your strategies at all?
No, I've had some people who've been telling me here, they're like, you should sell this one or you should that, and then the first time I almost did it, then I was like, you know what? No. If I start to sort of like invest it in a different way than I would invest it myself, then it sort of defeats the purpose. I have also purposely not, so I also copy myself, so that this is how I invest all my money. I wouldn't want to have another account with a different set of investments, because then it again removes the idea that I invest my money, and if you copy me, you are we are in the same boat. It's the thing, like, you should, as a cook, you should eat your own cooking. And I think you can have some big banks where they are advising their customer to invest in one way, and then they're themselves investing in the complete opposite way. And now you might say, like, but every person is different, so they should give differentiated investment advice. And that's also correct, but there's also some value to the idea that I invest in the way that I personally think I can get the best return for me at a certain risk profile. I don't take zero risk. I take some risk, knowing that I think this risk is worth it in terms of how much return I can get. And then a lot of other people who come from different needs and different profiles, I'll explain them, you need to think long term is risky, capital's at risk, and so forth. But also this, you're in the same boat as me. I'm not doing I'm not investing in a different way and then trying to sort of like sell you this thing. This is what I invest in with my money to make the highest return for me, and you can copy that.
So what do you rely on more, your gut feeling or research
No,
when before?
it's definitely research. I think gut feeling can matter in terms of the exact decision time, but I always sort of like, if I have any information or insight, or even if it was gut feeling, then that I put that into an Excel model, and then I adjust my weights in there, and then based on that I make a decision. And that's the same approach that I used as a management consultant when we were deciding, or helping companies decide on major projects. We'd say, what are all the important factors, how important is each of those factors, we score them within those things, and then out comes a result. And then even if there's some subjectivity to it, which that definitely is, it's mainly subjective, you still have that very clear approach where you're very conscious of why you're deciding something. And if you later on think that your decision was wrong, you can see very clearly what was wrong. Right, we've assigned a lot of importance to this thing, and actually that turned out to not be important at all. And when I bought my apartment, I did the same thing. I made an Excel file. I put in a lot of different flats I had looked at, and I scored them on the price and the location and how many rooms they had and so forth. And then I just sort of ranked them, and then I bought the one that came in number one. And that's how I do it with investments as well. But if I look at all the sort of like say that I've looked at it through the day, and at the end I'm feeling pretty sure I should be I should sell this one now, or I should be investing in this one. Gut feeling might determine if I then just go ahead, right, okay, I'm just going to go ahead and buy now, or I might decide, like, what, let me just sleep on it and review it again tomorrow. So I think that's the sort of, that can be at the end of the day, do I do it now or do I just sleep on it? That's a gut feeling decision.
So
Wow, you
it's
must have like.
basically, yeah.
Go
No, go
ahead.
ahead, Saksham, please.
So you must have a lot of Excels.
Yes. I'm always
Is it-
looking for other tools to. I'm always doing like I look because I like the research process, so I always try to use many different tools and just explore new tools and so forth. But I sort of always come back to this one again because it's very flexible. You quickly wanna change something, and that's also what you see sort of like when you are advising a large bank. You sort of always start out with anything new in Excel, and then the model changes, and you do various bits and bobs, and then only once a process has really stagnated and it's done in the same way year after year, then you transition over to, if it's really standardized, to like Essbase, or if there's still, if it's the data has just become too big but it's not being standardized yet, maybe you'll use Python or something. But it's there's sort of that transition before you go into this really locked down big cloud model of some kind. Then you are more you prefer the flexibility, and then you just have to deal with the sort of various. I mean, I have my ideas for which tools would be superior, and I'm really waiting for some of the big software providers to build me these tools. And whenever I use a new tool, I always get the disappointment of seeing like, oh, it can't do this and it can't do that. But yeah, the tools are getting
I
better
am
and better.
fascinated how you're using it for your professional life and private life while buying an apartment. And you also, and this is obviously stupid, but
Yeah,
it would be nice to use it for a relationship, like, to to see which factors matter the most
pros
and
and cons.
how much weight each carries.
Yeah, so the extent that I use Excel decision making is very, very far reaching.
Okay.
Great.
Should I ask the next question? I think you've already answered this question a bit, but if you want to add something, the question is, how do you gather intelligence before investing? Some websites, sources of information.
Yes, so there of course investing in big stocks, there is the big benefit that data has to be public. So you have all the publicly available data available very easily, but it can be structured in different ways. There are many different websites that provide the data to you, like Yahoo Finance and Reuters and Morningstar and so forth. Unfortunately, quite often they actually make mistakes. So they put in the data in a wrong way, or they ignore a bit. Sometimes they even get the currencies wrong. So this is actually a little bit silly. I don't know why that has to be this bad, but it just is. And so there you are, but there you can you can trust it to a certain extent, but then other times you have to go in and read the actual financial statement and find what is how do I actually evaluate this here. Also, with different industries are different, and even though financial standards are standardized, there are some things that you would consider in one way in one industry, but in a different way in a different industry, just because how they are, sort of what lies behind the accounting. Then you have a lot of sort of all companies have a major presence online, so the online is a great way you can from how their products are available in different countries and different sites, what people are saying about those products, how their social media appearances, what their CEO sounds like in some YouTube interview. And then you can combine that with, of course, what you see in the real world, so meeting people from the companies, what are they saying about it, how do they like the atmosphere in the company, is there, what is their excitement about now, what is their sort of disappointment in, and who are they afraid of in terms of competition and so forth. So with all of that, you have a vast amount of data, but it's sort of like I usually, as a rule of thumb, like you can get through it in 6 weeks. And that was also what I was trained to do as a consultant. You come into a new business, you don't know this business as well as the people who've been there for 20 years. Yet after you come with other skills that they are lacking as well. But after 6 weeks, you should ideally have the knowledge that they have about the business plus the additional stuff you have. And that means really quickly read everything you can, really quickly try to structure things in a good way, and find out what matters in terms of this product, find out what matters in terms of this industry. And then after a while you start to have a sense that, like, actually now I when I read something, I understand it. When there's when someone says something, I know I can start to see them being wrong, and then sort of like, all right, I feel like an insider now. I know it well, and I know it well enough that I feel confident that I could advise the management of this business.
Okay, yeah, that makes sense.
Right.
Do you want to ask the next one?
I would
Yes,
just say
I'm
one more thing. I also
Yes,
use a lot the websites of the largest investment banks and consulting firms. I think they provide excellent analysis. Also, some of the biggest like international financial organizations, they provide excellent reports and data on how the economy is going, how they evaluate new technologies, sort of which things they are advising companies to look more carefully at. That informs me a lot as well.
And this is all for free on their website?
Yes, mostly.
Oh, okay. Okay.
Right, great. Okay, so
Wait, one
Yep,
second. What are some of the
yeah,
paid sources that you use?
I'm not gonna
Companies
say
can
my
provide.
pay list of sources. I
Okay.
have a couple, and I'm very happy with them.
All right.
all
Okay,
right.
next.
Yeah, okay. So Yep, what do you do with all the money that you get from your investments? Do you splurge? Do you reinvest it?
I reinvest more than 50%, so I definitely have a high investment rate. As I've been making more money, my consumption has also gone up, but I do reinvest most of it, and I don't have any plan to sort of like take out from what I've been investing. So I reinvest most of what I make, and then hopefully that will continue to grow as well, and in the end have a, a sizable portfolio that I can then hand over to my children if I ever get one, or some noble cause one day.
Yeah,
Somewhere
so
along the line.
I think that's the aim, right? We all aspire to earn a lot of money at some point of pre-made, that is, by when can you become a millionaire? And we have so many people use it. And like similarly, we have one, how much do you need to retire? So I mean, these questions, yeah, that's kind of the aim, right?
Well, I mean, it's always nice to increase the size of one's portfolio,
Yeah.
and I think there's no upper bound. I think what will cause me in the end to sort of retire or something will not be that I've made a certain amount. It will be that I've been that I'm not ahead anymore. In the past years and now, I feel like I have a good edge. When I hear people say things, I'm like, yeah, but you're forgetting this thing, or I feel like I'm ahead in many areas, and this causes me to see some good opportunities and make good investments. But eventually I will reach a point, I expect, where I look at a lot of stocks and I'm like, right, I think this stock is worth this much, and that's what the price is. And I look at another stock and that's how much I think it's worth, and that's what the price is. At which point I'll realize, oh, I don't have any big edge over everybody anymore. So now I have to just accept mediocre results. And at that point, then then it's not worth to spend every uh, day, all day on it, because you can only do that if you feel like you really have an edge. So I hope that will last another decade or two. But of course, there's a lot of other young smart people that are working very hard, and they'll be trying to catch up as quickly as they can.
You're still thinking in decades. It was like one should think in decades. Like I hope it lasts
Yeah,
another
that's
decade.
amazing.
But yeah, okay, that's a good way to. I'm like always. It's good to know when it's time for one to get out of the game, because I think that's the risk in investment, right? When some people
Hmm.
don't know when to get out at all. So, uh,
I mean, there's also the thing, the invest in what you know isn't completely true, because obviously you cannot.
mm,
Everybody's only an expert in one thing or so. So if you only invest in that, you have no diversification. I generally invest in things that either I know or I know someone who knows it really well. So with some of
mm,
my stocks that have more high, advanced science behind them, I can't, even if I sit down and read a lot of papers on it, I won't understand it well enough. So it's much better for me to have somewhere I can say, so isn't it like this? And you're like, no, yeah, but where you're wrong is here and here, and your way you should think about it is instead like this. And of course, at different times, different things are really interesting to you, and you get an insight on something and learn a lot about that. But that changes over time as well. And even as the things you are personally interested about and the things you need change, that also changes what you might be getting some special insights into. And that's what can lead someone like Terry Smith and Warren Buffett to, even even at a higher age, they're still finding great companies to invest in, and then years later, like, oh, they did it again.
I was gonna say, because obviously once in a while there comes up in a market a company like Theranos. Do you know Theranos?
Yes.
Uh, yeah. So and people fall for that. And why do you think that tends to happen? Because like the people did fall for it at such a huge scale, right? That entire scam that happened. So what
Yeah,
do you
and
have
so
to think
many
about
many
that?
of the blockchain projects like Neta, for instance, like that, right? And the other companies that are having high growth, but I don't expect they will ever be extremely profitable. So there's definitely ones that like that that you can already see are surprising some people. And you can always, I mean, if people you can tell when you listen to what people say, you can hear whether what they say is logical or if there's some flaw in their logic. And
Mm,
often there's flaw in people's logic. But then there's a question of sort of like size, like um, if any sort of like small project or company is overvalued and declines in value, that doesn't do much. If even if you were unlucky to have invested in that, that's only going to make up, in my case, I rarely invest more than like 5% of my portfolio in one stock. So that's not going to wanna
mm,
what's gonna change anything in any given period of time. What can more change something is if you look historically, if there's, for instance, a country who's been lying about their debt levels, and suddenly it turns out it's much worse than was expected. That can cause a problem. If you have a whole industry where it was just expected that there were so great prospects here, and then in a very short period of time all hope for those prospects disappear, that can then,
mm,
then be big enough to, essentially, the global economy is quite resilient. It can take some punches. Whenever you hear something in measured in billions, you can usually ignore it. It has to be in trillions to be able to sort of like knock it off course. and
mm,
and and so it's not really enough that there is so like one little like a bad egg in one little company like that. There has to be some more like a profound misunderstanding or a profound lie, or
mm.
something like that suddenly is revealed, and then causes
A
some bigger
meltdown.
forces to come into play. And then you evaluate all those things and rank them, and then see, is this big enough, is this big enough? If this
Mm,
happens, then are we talking a half trillion in damage? Fine, the global economy will be fine. If it's and then only once you're like, okay, now it's a couple of trillions, they've raised the interest rate, do we have enough resilience then to beat something like that? Then only once like it's above a certain threshold, you I start to look at it as something like, oh, I gotta keep an extra eye on this. I gotta start worrying about that. But I mean, I think now we have quite good growth around the world. Inflation's quite low, and we have managed to increase the interest rate, which provides actually, I would say, safer environment than a couple of years back. And I mean, the big risks that everyone's been talking about since Davos are still Brexit and U.S.-China conflict and so forth, and you know, you can keep an eye on those. But I think all the most likely outcomes of those things are below the threshold of what would really send the global economy tilting right now. So sort of I expect more that there must be some black swan. So I'm, you know, working hard to see if I can be the one to spot that black swan, and then yeah.
I was gonna say, well, since you have to keep track of all this knowledge and always be like, you know, have an edge, always have an edge, in this, let's just say, market, have you ever thought about doing a startup of your own? Because all of this knowledge might actually be helpful for a
Yeah,
company owner.
I thought about it a lot. In I got close a couple of times. I've had some ideas that I thought were good and so forth. And I think at the end, what made me not become an entrepreneur was I didn't like the social environment there.
Mm,
I felt much better in simply socially. I felt much better as a consultant than I did as an entrepreneur. Whenever I approached people um, from the mindset of an entrepreneur or met with other entrepreneurs, there was this idea that like you haven't made it yet. You're not, you know, who are you? Why are you
mm,
here? You know, why do you think you're special? There's sort of like a little bit derogatory attitude. But when you come in as a consultant, it's like, thank God you're here. We've been looking for some people for so long, and we have this big issue, and you know, we're just so happy you guys are here now. What do you want? You can have anything you want. You know, just let's just get this thing done. It's really important for us, and you just feel so appreciated. So you like, so you just so then you can talk about which work is more inherently interesting and so forth. But when you do some work that people really appreciate, then that's actually also that can give you a nice feeling and make you really enjoy the job. And I really liked sort of like consulting set up so well in the terms that, you know, projects only last like 3 months. So at the end of them, you've done it. You know, you get some gratification like that. They always give you like
mm.
promotions and raises, so it almost feels like a computer game. So I think they've really just like managed to make that whole process that you feel really good about sprinting to achieve something, working well with your team to get it done, reaching those milestones. So it's much more sort of like smooth like that. And that can create a nice atmosphere. And then you know, then on top of that, I've gotten the investment thing here, and then yeah, then I think there's simply been no time left to pursue other things. There are many things given enough time. There are so many things I would like to do, and you know, there's just only so much time.
Okay. So, Anushka, you want to go ahead with the last question?
Yeah, okay. So, what are some tips that you'd like to give novice investors? Or basically something that you wish people had told you when you started investing?
So it's not something that I wish they had. That's very different questions, because for
Okay.
I already had my master's degree in finance and worked advising companies on
Right.
valuation. So I knew very. I did not start investing and then learn. I learned about investments and knew a lot about investment, and then I started investing. So it's a
Okay.
different approach. But what most people that don't know anything about investments should learn before they get started is, firstly, if you have debt with an interest rate of more than 5%, maybe even 4, I would generally say you should pay that off before you start investing in stocks and bonds. So because just getting rid of that is actually sort of an investment as well, because you're no longer paying those interest payments. Then historically, stocks has been the best investment, followed by property, which has been okay as well. Bonds has been okay, but then forex and commodities has been quite bad. So if you're buying your first house, that can be quite good, but also investing in stocks can be quite good. And again, as stocks have doubled in value every decade, if you do think in terms of decades, money that you do not need to spend right now is really well placed in the markets to, you know, build a fortune over time for yourself or for your family. And then I think you should definitely use a platform, one of the sort of like new smart platforms, rather than your own bank when you're investing. And you should think about the fees. If you usually your own bank will have very high trading commissions, and they might even have like an annual fixed fee and so forth. So it can be very, very expensive to trade through your own bank. And that's where some of the newer companies like Etoro, the one that I use, and Saxo Bank and Interactive Brokers and Robinhood, they've simply taken the price level far, far down compared to that. So you're getting, you're buying a stock for way cheaper. Now Etoro, I back in the day also make an Excel sheet to see which platform to use. So I compared these ones on the
That's really
pricing, did I like the website, the mobile, and then Etoro came out as the best one. And then I picked that one. Now since then they've reduced the fees for stocks to zero. So it doesn't cost, there's just no fees for trading stocks, and that's what I primarily trade. So when you pick a platform like that, it's nice that you pick the one that's best, but it's also nice that you pick the one that is getting better over time, so that it's not like the other one gets a new feature and using that you don't have the feature. The other one is lowering the price, but suddenly they raise your fee. Something like that's not nice. You gotta think it ahead and think like you're picking a platform where you think, wow, this is really cheap and great now, and you also think this platform will be better and better over time, and that they will, keep the prices at a low level, or at least, stay competitive and so forth.
Okay, so I think that's about it. That's all the questions. Thanks for joining us, Jeppe. It was a great
Yeah.
chat with a lot of tips and a lot of
Yeah, we
information.
definitely learned a
Yeah.
lot.